Hey, Alex here again on Financial Accounting 202, uh, Chapter 11. This is problem exercise 11.1b, proceeds from notes payable. I made a mistake in the example video. I was thinking about notes receivable. When you discount a notes receivable, you sell it to the bank for a discount, and then you might either make money or lose money. On a notes payable, you can discount it, but it's a different. It means something different. It means when you discount it, it means the interest is paid up front instead of at the end. So here's an example. On February 1st, Tenter Company issued a 60-day note with a face amount of $120,000 to Tonk Warehouse Company for cash. So the things we're trying to figure out is A, determine the proceeds of the note, assuming the note carries an interest rate of 9%. So this is basically the normal, if it's just a normal note. And then B, determine the proceeds of the note, assuming the note is discounted at 9%. And this is assuming a discount is taken. And the difference is, if it's a discounted, you pay the interest up front. If it's not discounted and it's just a normal note, it's going to be paid at the end when you make the payment. So here's the first one, and this is the normal way. So you have 120,000 times 9% times 60 days over 360. So remember that, because you're only paying interest for the days you have it, not the full year. If you did it only by the 9%, you'd have that's a full year's of interest, but it's only 60 days, which gives you $1,800 interest that you'll pay. And then to find the maturity value, you take the 120,000 plus the interest equals the maturity value is 121,800. So that's the amount you'll pay back at the end. And if you come down here, the journal entry would be you debit cash to get it. So the bank gave you cash, or the supplier or the business gave you cash, and then your payable is the same amount of cash, so 120,000 notes payable. And then when you go to pay it at the end of the 60 days, you're going to debit the payable for the face, 120, but then you're going to debit the interest expense for the 1,800 to match it, and the cash is going to be the full amount that you'll pay. So you borrowed 120,000, but you ended up paying 121,800. That's because that's one way to make money, is loan money. Money, you got to pay for it. And then let me see. And then interest is an incentive for the lender to actually lend money. And then on this one, assuming we do it a discount means there's no interest rate. It's just discounted right up front. So you're going to debit cash see how it's different? You're going to debit it for the 1,800 and 20,000 and 118,200. Oh, sorry, I need some coffee. And then you're going to debit the interest expense for the 1,800, so the same amount. But then your notes payable is going to be for the face amount of 120. So see how a discount makes it to where you get less money. It's almost like you're paying the interest up front, and then you don't have to pay it at the end. So the normal way is either paid up at the end, which is the normal notes payable interest-bearing note, or if it's a discounted notes payable, you pay the interest up front and you get less cash. But then you'll just pay back the face amount. So you'll still pay back this amount, but you've already deducted. They're not going to give you the interest that you owe them. They're going to keep that out of it. So that was an example of a note, which is a big part of the chapter. Sorry about the confusion in the last video. I think we'll do receivables in this class also. Notes receivable. Yeah, and writing them off and all that. So thank you, and I hope you have a good day. We're going to do I didn't touch much on payroll because maybe I might do a video later, but for now I just wanted to do kind of like the bulk of it. And so I'll see you again, and next week I'll do chapter 12. So thank you, and have a good day.